Good day, investors. Today we are starting a series of looking into oil and gas companies regionally. First, we're going to do Canada in part 1 and then tomorrow part 2. So generally the outline is the oil thesis, oil and gas in general, and then in Canada particular. Then we're going to look at some KPIs, compare the stocks and do a summary. So we're going to cover these 5 companies today. We're going to do ARC, which is a Montney focused producer concentrated in natural gas and condensates. Peyto, which is a natural gas focus play. Whitecap, which is also oil and natural gas mix across the Western Canadian Sedimentary Basin. Freehold Royalties, of course, is a royalty company with one of the largest oil and gas royalties in Canada, and they have a growing interest in the US. And finally, Birchcliff, which is heavy gas focused. Now, the general thesis is that hydrocarbons are still the majority of the energy mix. As GDP grows, energy consumption grows with it. Oil is at 20-year lows, inflation adjusted. And finally, today low prices are leading to low capex, which will lead to higher future prices. Now, looking at Canada, the US is importing majority of its crude imports from Canada, right? Because they need heavy crude. And then if you look at the other part of Canadian story, you see basically the VTI, right? So this is a US light sweet benchmark, and the VCS, which is Canadian heavy sour benchmark. The differential is between the two. So what's the discount of the Canadian versus the US? And the discount, it happens because basically lower quality and transport and other bottlenecks. That's basically you have a widening or closing or tightening, narrowing gap. So widening when you have pipeline and transportation shortages, or maybe refinery outages, or just demand falls. And then narrowing could happen if the transportation capacity of Canadian oil increases, or there is just higher refinery demand. So basically, if you have a midstream build out, an infrastructure build out in Canada, that should narrow your differential. And then side note, Venezuela could technically widen the differential if the quality is similar to the Canadian. Now, this is story 1. So midstream build out is good for Canada. Story 2, the decline rates. So oil sands are really low decline rates compared to all the other, and you can see that shale is declining very steeply, especially in the first year. So Canada is really good with their decline rates. They get long life assets. Now, looking at the gas story, this is really simple. You have the European price. So everything here is dollar and BTU. You get the European gas price, you get the Henry Hub price in the US, and then you have the Canada gas price. What you see here is that huge gaps between the prices. So if you can just get this Canadian local gas priced at the US price or priced at the EU price, you're going to make a lot of money. So the story here is get transportation infrastructure in place. That is your business case, and basically have these prices converge. That would mean this should come down and this should come up, basically. So that's your arbitrage, just get the gas moving. But how to do that, right? So for those who are familiar with my work on X or here, especially in Canada, my core thesis has been unlocking the Canadian energy story, particularly natural gas, to global markets and capturing large price differentials, as we've seen here. Now, ironically, the renewed focus on Venezuela could provide a political catalyst finally for Canada to do this and greenlight these major projects, meaning all these headlines you can see, instead of just sitting tight and waiting, Canada can build out due to the Venezuelan threat on their access to the US market. They can diversify globally and get a better price for their hydrocarbons. Now, looking at the companies, we're going to cover these 5s, and then first we're going to look at the production mix. So you have gas here, you get liquids here. You can see that Peyto and Birchcliff are pretty gas heavy. ARC is also pretty gas heavy, and then you have the other 2 companies with more liquids, but everybody here has a lot of gas, actually. Looking at valuation, here I get basically an annualized 25 Q3 free cash flow yield, and then here is my discounted free cash flow value. What you can clearly see is that ARC Resources looks cheap on both metrics, or the cheapest among these 5, followed by maybe Peyto, both on both metrics. So the current free cash flow yield is already pretty good on these, but I think there is more for them to grow. And then you still have Whitecap in the positive area of both free cash flow and discounted free cash flow. And then you have Freehold and Birchcliff. They have nice 6 to 8, so 6.5 and 7 something % current free cash flow, but my discounted free cash flow is weaker for them. Of course, all my calculations use the same commodity price assumptions, so what ARC used was also used for Birchcliff and Freehold. So that's, and based on the same rule, they look like less of a value play. Of course, if gas prices move more than my assumptions, then ARC gonna benefit only 60% and Birchcliff like 82 because they are more gas exposed. Now, looking at profitability, you'll see that both return on equity and return on investment. These are 7-year averages, so it's not as volatile, 2018 to 2024. You can see that Whitecap was the most profitable during this period. What you can see, a couple back here, that they are heavy on liquids. So what I see in the data is that usually companies who are more oil heavy did better in the past 7 years. And if the thesis is that gas is gonna relatively go higher than oil, then that makes sense that in the past 7 years, gas did worse than oil, and we'll see how in the future it looks like. But if gas outperforms oil, then gas-heavy companies should have a better future profitability. That said, Whitecap did pretty good in the past 7 years, followed by ARC, which is interesting because they are 60% gas, 40 oil. Or when I say oil, it's just liquids, right? So ARC is doing a lot of condensates, which is in a shortage in Canada, so that's fetching a pretty nice price. Then you have Peyto, which is really, really interesting because they are 88% natural gas. So Birchcliff is only 82. So if my thesis that the more gas you had in the past, actually you did worse on profitability, not quite right. So Peyto outperformed Birchcliff. And then you have Freehold lagging all of them. So this poses really good numbers for Peyto, actually. Now, looking at their financials, their debt, you have interest coverage ratio here and debt to equity here. So these red lines are my preferences. So what I want is less than 50% debt to equity and more than 5 times interest rate coverage. What you can clearly see is that Birchcliff is pretty low on debt to equity, but their interest coverage is just a bit messy, to be honest. So I'm not sure. Maybe I have to go back to look at my financials, but they might be struggling here. And everybody else is fine. So everybody else has less than 50% debt to equity and more than 5 times interest rate coverage. Looking at the reserve life, you can see that they're all pretty good. Freehold is a bit lagging and Birchcliff has a lot of reserves, but everybody's fine here. This is Canada. These are low decline assets. So there is no worries on the reserve side. And then finally, let's do the judgment call. So this is my ranking and this is my opinion. Probably I miss some items, some management calls, about some merger story here or there. But how I see it is that ARC is a clear winner. The valuation just looks pretty good on both current free cash flow yield and future discounted free cash flow. Profitability is second to only Whitecap. Debt is manageable, reserves are manageable, so everything is pretty good. They have enough natural gas, but they also have a mixed product of condensates and oil, so that makes it a good story. Qualitatively, well, their management is just great. You can watch the interview with the CEOs and the podcast. So ARC Resources is basically the highest quality name on this list, I would say. Great execution, strong market access, and the disciplined capital allocation. So management here is clearly a shareholder friendly with strong buybacks and the dividend and dividend discipline. Followed by Peyto. So valuation is great. Historical profitability lags a bit, but I contribute that to basically natural gas prices performed less good than pure oil. Their debt is fine, but less good, a bit higher debt to equity, but they are still healthy. I just wanted to differentiate between the really good balance sheets versus maybe a step down, but this is fine. Reserves are really good. They are really gas heavy. So keep that in mind, that if you want to play Canadian natural gas and then you want a full beta, you can probably pay Peyto. So qualitatively, Peyto is a low-cost leader in Canadian natural gas. It's built to survive weak gas markets and really benefits when pricing improves. Management is extremely disciplined and conservative, and the whole company culture is focused on efficiency and cost control. Third, I would put Whitecap. So valuation looks pretty good. Third actually in the list. So profitability was the best in the 7 past years. As said, they are more oil heavy. Debt is really good. The balance sheet is nice. Reserves are pretty good. And they are liquids 60 and 40 to gas. So liquids. And on the qualitative side, well, Whitecap has a strong asset base and attractive economics. But the key question is whether management stays disciplined after all the M&As they did. So management can execute, but the acquisition-driven strategy created in the past dilution, alignment concerns. So that's still there for me. Fourth, Birchcliff. If you look at the valuation, it's maybe it's cheap enough because this is not as cheap as these others. Profitability was lagging. Debt is. I actually stopped the recording and I had to go back to my numbers, and I opened up their Q3 25 report to look at the interest expenses, and it was 26.5 million Canadian. So yep, that interest coverage is pretty weak for 25 at least. Reserves are really good. They are the best. So they have a lot of reserves. If they're not gonna probably go bankrupt, right? And their reserves gonna worth a lot. Liquids limited, and gas is where the real story is. If you watch Rick Rule, he said Birchcliff multiple times, and they're basically the potential of having 35 years worth of gas reserves. So this is your gas Canada play after Peyto. Qualitatively, well, Birchcliff is more of a high beta gas play. It can do very well if strong gas happens, but the downside is that cash flows can get pretty volatile. Management execution feels a little bit mixed, and the company doesn't have the same best-in-class discipline as let's say a Peyto does. So this is a more leveraged gas play, higher cost than a Peyto. Now, looking at Freehold royalties, valuation looks weaker than the others. So this is also relative to each other. Profitability is probably, I think it was the weakest of all of them. Debt is manageable, not horrible. Like only everybody has decent debt. Only Birchcliff. Decent balance sheet. Only Birchcliff has a bit of an issue with the current interest rate coverage, but that could be also timing, right? So Q3 year to date, maybe they have Q4 less, so annualized, maybe I'm overstating it. Right, and then debt is fine. Reserves are good, 11 years, and that's the weakest of them all, but that's still a good amount. But the issue can be with Freehold is that they might have to do more big deals, right? Because they are a royalty company. They are liquids heavy and less gas, so that's less of a gas beta play, right? So Freehold is a great business model. The royalty structure is attractive and the asset base is diversified, especially with a growing US exposure. But management gets a weaker qualitative score from me. So if you're more curious on that, you can watch my video on it. Because of past dilution and capital allocation concerns I have, which weighs on an overall confidence from my side. So they did a lot of dilutions and big, and they are not spending capex, right? They are a royalty company. They're gonna buy into big deals, and that can weigh on their free cash flows. So that's my list, and that's my take on Canada. Tomorrow I'm gonna do part 2 with 6 companies, and I'm really curious what you guys think, because I'm learning a lot from the comments and the feedback, and it is amazing. It's a nice journey. Thank you all for watching, and thank you all for your support, and I'll see you next time. Take care.